So, good morning, everyone. And first of all, I would like to thank Tim and everyone at the Institute for inviting me. It's a real honor and a great pleasure for me to be here today. So, my name is Demeulemeester. I'm a historian of economics, and I will be talking about a monetary reform idea to which I dedicated my PhD research, namely the 100% money proposal. As you all know, modern monetary systems are characterized by public-private partnerships of money issuance. Public money issued by the state has legal tender status, but is only accessible to the public in the form of physical cash, so that the medium of exchange, the bulk of the medium of exchange, actually consists in private money made of transferable bank deposits, the safety of which is guaranteed by the state. Now, one may argue that the resulting dependence of money creation upon bank loans and investments has been a source of instability, or at least of monetary difficulties, on a couple of occasions in the last decades. During the global financial crisis of 2007-2008, for example, as Mervyn King explains, the amount of bank money was contracting rapidly, which forced central banks to massively intervene through quantitative easing in order to prevent the whole volume of money from falling. And this episode led King to argue that the creation of money by private sector institutions was, in his view, the most serious fault line in the management of money today. More recently, the inflationary episode that has been following the COVID crisis has led central banks to implement upward manipulations of interest rates in order to discourage money creation by the banking system and to contain inflation. Interest rate hikes, however, by making access to credit more difficult, also convey the risk of precipitating an economic recession, which is why central banks have been so hesitant in raising rates. This kind of dilemma, again, directly arises from the fact that money issuance is so largely dependent on bank loans. Yet, as David Ricardo explained long ago, there is no necessary connection between the issuing of money and the making of loans. These two functions, he held, could be separated without the slightest loss of advantage, either to the country or to the merchants who receive accommodation from such loans. And in fact, since Ricardo's time, the issuing of paper money has actually become a state prerogative in most countries. But paper money, of course, represents only one part of the circulating medium. And since the late 19th century, at least, a number of economists have been calling for extending the state issuing prerogative to its other parts, especially scriptural money. This was the purpose, in particular, of the 100% money proposal that was put forward in the context of the Great Depression of the 1930s in the United States by, among others, a group of University of Chicago economists led by Henry Simons, who came up with what has become known as the Chicago Plan of Banking Reform. Lachlan Curry of Harvard, who also advocated such a reform when working at the US Treasury and at the Federal Reserve Board. And Irving Fisher of Yale, who quickly became the most active proponent of this reform idea, of which he provided an elaborate rationale in his book 100% Money, first published in 1935. And as you will see, I will be quoting a lot from Fisher in this presentation. The essence of the 100% money proposal, according to Fisher, was to make money independent of loans, that is, to divorce the process of creating and destroying money from the business of banking. The medium of exchange under all versions of the 100% money proposal would be based on fully reserved checking accounts, kept with commercial banks or with other payment service providers, or what would practically amount to the same thing, a public digital currency, as was recently suggested in the sovereign money proposal, which is an updated version of the 1930s reform plans. In this way, all the means of payment circulating among banks and non-banks alike would be created by the public monetary authority. The latter could inject money, for example, through open market operations, or in coordination with the Treasury through tax credit, public expenditure, or direct payments to citizens. Now, insofar as bank intermediation was concerned, two very opposite approaches were taken. The first one corresponds to what I call the basic version of 100% money, as was supported by Curry and Fisher. Under this version, the banking system will remain mostly untouched. The banks will still use fractionally reserved deposits as part of their core intermediation function to collect savings and finance loans and investments. The only difference is that these deposit liabilities, what are here called savings deposits, could not be used as a means of payment by the depositors. So we would still have fractional reserve banking, even though only full reserve money would be circulating as a means of payment. And the banks themselves, for their own transactions, they would have their own checking account fully covered by reserve, both the banks and the customers. But the deposits that would be used as credit instruments to collect savings and make loans, these could not be used as means of payment. Fisher further suggested splitting up central banks into two institutions: a money issuing authority, solely charged of issuing money and regulating its value in accordance with its prescribed legal mandate, for example, stabilizing the purchasing power of money, and a non-money issuing central bank or banker's bank that would be centralizing the reserves of loan banks and providing rediscount facilities. In this way, the issuing of money would be entirely dissociated from the banking and money lending system. Now, the second approach was specific to the Chicago Plan, which, in addition to 100% reserves on checking accounts, called for the outright abolition of deposit banking on the fractional reserve principle. Here, fractional reserve banking would disappear, and the banks would be replaced in their lending function by equity funding investment trust. Now, let me specify that, as far as I'm concerned, I fully agree with what has been said in the previous presentation about the utility and importance of fractional reserve banking. And this kind of proposal, under which bank intermediation would be abolished, is not at all something that I would personally advocate. Yet, despite of its radical character, the Chicago version of the 100% money proposal would become the most representative of this reform idea. In some part, perhaps, because it was this version that Milton Friedman would himself propound in his writings. And whether for this reason or not, there has been much confusion to this day about the implications for the banks of the 100% money reform, which is often viewed as necessarily involving 100% reserves on all bank deposits, meaning, of course, the end of banking. It was precisely for this reason that I have addressed this question in detail in my first article published a few years ago. Now, to revert to the basic version of 100% money, I would like to emphasize the fact that under this version of the proposal, the banks would still be fractionally reserved and potentially highly leveraged. They could still perform risk and maturity transformation by borrowing short and lending long. They could still even provide overdraft facilities as long as this was done with pre-existing money. And the savings deposit here could be redeemable maybe on site or on demand, as long as they could not be used as means of payment themselves. So again, fractional reserve banking would still be there, which leads me to argue that such a proposal would amount not so much to a banking reform as to a reform of the monetary social convention, deciding what is acceptable or not as a means of payment. Historically, such various things as cowries, wampum, playing cards, tobacco, bills of exchange, or gold have been used as a medium of exchange within specific payment communities. And today's convention, as already mentioned, acknowledges as money both legal tender cash and fractional reserve and private bank deposits. This could make sense perhaps as long as the monetary base was metallic and relatively inelastic. But from the moment that the monetary base is itself made of manageable fiat money, one may ask if such a convention has not become a barbarous relic, and if legal tender money could not be extended to the whole perimeter of the means of payment. This, at least, is what will occur under a 100% money reform, which would establish a new monetary social convention under which only public money would circulate as means of payment. And again, just like gold remained gold, or tobacco remained tobacco, after being demonetized, banking would remain banking, even though the payment community would no longer be using the bank's promises to pay as a circulating medium. Now, all this being said, what would be the advantages of such a reform? The 100% money theorist in the 1930s, writing before the Keynesian revolution, used Fisher's equation of exchange, MV equals PT, as the basis for their reasoning. And they ascribed the severity of the Great Depression to the drastic monetary contraction of 1929-33 in the US, during which the volume of bank money had fallen by a third. Such a contraction, they said, could never have occurred had the stock of money not been so largely dependent on the banking system. Now, they did recognize that the Federal Reserve System was much to blame for its passivity during this episode. They also recognized that money could somehow be managed under the existing system. But in the face of the handicaps of the existing regime, they insisted that the 100% system would be much better for a number of reasons. So I will now present 10 arguments in favor of this reform, the first 7 of which were put forward by the 1930s writers. The first argument for a 100% system is that it would prevent cyclical variations in the circulating medium. Unlike some later trends of monetary thinking, the 100% money advocates in the 1930s did not believe in any mechanical relationship between base money and the total stock of money. Quite on the contrary, they insisted that in the short run, the creation of money by the banks would be the source of a reciprocal causality relationship between money and prices, so that bank-created money would follow a cumulative behavior of its own. In the upswing of the cycle, the businesses would increase their borrowings from the banks, which in the existing system would lead to an increase in deposit money, which would lead to an increase in prices and profits, prompting businesses to further increase their borrowings from the banks, bringing yet more deposit money into existence, and so on until the boom phase gave way to a depression phase and a cumulative downward movement. So the purpose of the 100% money proposal was precisely to cut this tie between money and debt. With 100% reserves behind checking accounts, an increase in bank loans would no longer bring an increase in the means of payment, so that these cumulative interactions between loans, money, and prices could no longer develop. This is why Fisher argued that such a system would allow for a true elastic currency better adapting to the needs of trade. Let's now turn to the second argument, according to which this reform would allow for unhampered interest rates. Fisher, for one, argued that even when the central bank was successful in stabilizing the price level in the existing system, in spite of the cumulative behavior of deposit currency, such a stabilization could only be obtained at the price of another kind of distortion affecting interest rates. This was because as long as money creation depended on bank loans, the monetary authority would be led to manipulate the price of loans in order to vary the total money stock. And the virtue of the 100% system in this regard was to allow varying the quantity of money without having to interfere with bank lending, so that interest rates would seek their level in a natural way according to the supply and demand of loans. There would no longer be any need to keep interest rates artificially high or low in order to prevent inflation or deflation. The third argument is about facilitating monetary control. In the current monetary system, the volume of money depends on the actions of a great number of actors, whose decisions, except for the central bank, are exclusively governed by private concerns, while the policy decisions of the monetary authority not only impact the volume of money, but also interest rates and the loan market. The 100% system would suppress these mutual interferences between the private market sphere and the public monetary sphere. The volume of money would be exclusively determined by monetary policy considerations, while monetary control would be greatly facilitated. Not only would the issuing authority no longer need to lean against the wind of cumulative variations in bank money. It could also adjust fully and directly the money stock, regardless of the willingness of bankers to lend or that of businesses to borrow. Importantly, every dollar created by the monetary authority would necessarily result in a one-to-one increase in the total money stock, as there could be no expansion or contraction of bank money occurring at the same time. This is why Fisher argued the adjustments would be smaller than are now necessary, and the stabilization would be more precise. The next argument is that such a proposal would completely secure the monetary and payment system. With 100% reserves on checking accounts, the circulating medium would become indestructible in the sense that no unit of money could be extinguished as a result of private agents' decisions. As Fisher said, even if depositors should withdraw all deposits at once, or pay all their loans at once, or default on all of them at once, the nation's volume of money would not be affected thereby. Of course, runs on savings accounts could still occur and represent a risk for the banks, but they would not entail any contraction in the circulating medium. As a result, deposit insurance could be largely dispensed with. The fifth argument is about reducing government intervention in banking. In the existing system, by sharing with the banks its power to create money, the state necessarily has to intervene in banking, whether by varying reserve and capital requirements, manipulating interest rates, or guaranteeing explicitly or implicitly the safety of bank deposits. Under a 100% system, in contrast, the monetary and banking system would be completely insulated from the financial sphere. So there would be much less reason for the state to intervene in banking. This is why the 100% money writers argued that the banks would be far freer to lend money as they please under the proposed reform plan. The next argument is about financial stability. The advocates of this reform in the 1930s did recognize that the reform plan would not do away with financial instability. The credit cycle, in the sense of a debt cycle, would still exist, and bank intermediation carried out with savings accounts would still be a risky activity. Yet financial instability could still be alleviated to some extent for different reasons. First, as already stated, booms and busts would no longer be exacerbated by variations in bank money, so that the circulating medium would no longer be itself one of the elements fueling the cycle. Second, as money creation would no longer depend on banks, deflation and inflation could be prevented without having to ease or toughen borrowing conditions through interest rate manipulation, which should lead to more stable access to funds for businesses. And third, insofar as deposit insurance and other guarantees to banks could be dispensed with, a source of moral hazard would disappear, which would, again, reduce risk-taking. The seventh argument is about improving public finances. A 100% system, in particular, would allow the state to fully benefit from the seigniorage profit stemming from money issuance. So this is an old argument, and that was already expressed by Ricardo, insofar as the issuing of paper money was concerned, and that the 1930s writers would extend to the case of scriptural money, which led them to argue that their reform plan would eventually result in a significant reduction in the national debt. Public finances could further be improved by the fact that deposit insurance again would become less necessary, and by the fact that the state would no longer need to increase its deficit in times of depression to maintain the volume of money when the private sector is deleveraging, as there could be no such monetary contraction occurring in the first place. Now, in addition to the preceding arguments that were put forward by the 1930s writers, there is reason to believe that such a reform would allow resolving several dilemmas of central banking. In the first place, a monetary authority facing a rising price level would no longer need to choose between rising interest rates or letting inflation run. It would merely have to reduce its pace of money creation without having to manipulate interest rates in any way. And second, there would no longer be any trade-off between monetary stability and financial stability. As mentioned, such a reform would likely result in a separation of functions at the level of the central bank, while the issuing of money would be vested in a monetary authority, solely charged of regulating its value. The other central banking functions, including contributing to financial stability, would be exerted by a non-money issuing central bank. So considerations of monetary stability and financial stability would be entirely separated. Only as a safety valve, perhaps, could the issuing authority potentially be allowed to come to the rescue of the financial system if this was really warranted. The ninth argument is that the 100% system would allow money creation to be more neutral from a distributional point of view. First, the purchasing power of money should be better stabilized, reducing money illusion and unwarranted wealth transfers between debtors and creditors. Second, unimproved interest rates and lessened government intervention in banking would allow free market conditions to better prevail in the financial sphere. And third, the whole of the seigniorage profit would accrue to the state, thereby benefiting all taxpayers or citizens equally. This reform could also help answer the Cantillon effect problem, according to which newly created money has distributional consequences depending on its spot of injection. In the current monetary system, as money is created through bank or central bank loans and investments, it enters into existence where these loans and investments take place. That is mostly today on house or asset markets, the prices of which, therefore, are primarily impacted by money creation, which arguably results in exacerbating asset price bubbles and wealth inequalities. A 100% system, on the other hand, would allow money to be injected much more evenly. Insofar as it was created through tax credit, benefiting all citizens, all taxpayers, or direct transfers to citizens, money would enter into existence across all the economy at once, thereby reducing the distortionary effects of monetary policy. The same would not be true, however, insofar as it was injected through open market operations or public expenditure, whereby it would still enter the economy through specific injection spots. Lastly, there is reason to believe that this reform would allow bridging the gap between money in theory and money in practice. All money would be created by the public monetary authority, and the banks would become true intermediaries between savers and borrowers, lending out the savings previously placed with them. Such a state of things would not only correspond to the idea that many people, if not most people, have of how the monetary and banking system currently works. It will also correspond to the assumptions commonly made by mainstream economic models, in which the supply of money is often considered fully exogenous and the banks true intermediaries, like, for example, in the Diamond and Dybvig model. Such widely held assumptions, however, would only become true under a 100% system. Thank you for your attention.